Hey everyone, welcome back to Corporate Decoder, the place where we really dig into the gritty details of corporate filings. Today we're looking at Papaya Growth Opportunity Corp. Its latest report, and let me tell you, it's a wild ride from SPACs to potential business combinations with some interesting twists and turns in their financials. If you love breaking down these financial reports to understand exactly what is going on, make sure you hit that subscribe button. And hey, we've got a fantastic community over on Discord, linked in the description below, where we dive even deeper into these topics. Alright, let's jump right into what's happening with Papaya Growth Opportunity Corp. As of the 31st of March 2025, this is a really interesting case study because it's a SPAC, a special purpose acquisition company, and those have their own unique financial story. First up, let us look at their balance sheet. For the quarter ending the 31st of March 2025, we see a significant drop in their cash held in trust account. It went from over $8 million at the end of 2024 down to just over $1 million by the 31st of March 2025. This is a massive decrease, and it really tells us something important is happening. When we look at the other side of the balance sheet, we see that total current liabilities are over $24 million, while total liabilities are the same. Now that's a lot of money owed compared to their assets, and a big chunk of this is coming from deferred underwriting fee payable, which stands at a massive $15 million. This is a fee due to the underwriters. Contingent on a business combination. Then we have the class of common stock subject to possible redemption. This is where things get really interesting. At the 31st of March 2025, the redemption value was over $1 million, down from over $8 million at the end of 2024. This huge drop in redeemable stock aligns with that decrease in the trust account. It means a lot of shareholders decided to get their money back instead of waiting for a business combination. And speaking of deficits, their accumulated deficit is a staggering negative $24 million. This isn't unusual for a SPAC that has not yet completed its business combination, but it's a number worth noting as it shows the ongoing costs of being a public company. Now, let's look at the operations for the 3 months ended the 31st of March 2025, Papaya Growth Opportunity Corp. I reported a net loss of over $881,000. Now, that might sound bad, but it's important to remember they are a SPAC. They are not generating operating revenue yet. Their main expenses are general and administrative, which were nearly $900,000 for the quarter. They did earn some interest on their trust account, about $18,500, but this is a tiny amount compared to their expenses. Comparing this to the previous year, for the 3 months ended the 31st of March 2024, their net loss was around $395,000. So the loss has more than doubled. This increase seems to be driven by those higher general and administrative expenses. Their basic and diluted net loss per S-share for class of stock was a negative 80 cents compared to basically zero in the prior year. This reflects that growing loss relative to the remaining shares. Moving on to the statements of changes in stockholders' deficit, we can see how these numbers play out over time. For the 3 months ended the 31st of March 2025, there was a significant decrease in the total stockholders' deficit. A big part of this was due to the redemption of common stock, which drained over $7 million from their equity. The net loss for the period added to the deficit, as expected for a company in this stage. Looking at the same statement for the 31st of March 2024, we see a different picture. There were several adjustments here, including the conversion of Class B common shares to Class A. The net loss for that period was about $395,000, and it also added to the deficit. Now, cash flows tell a crucial story. For the 3 months ended the 31st of March 2025, cash flow from operating activities was a negative $16,324. This negative number is mostly from operating expenses, but the real action is in the investing and financing activities. Cash from investing activities was over $7 million, primarily driven by a large withdrawal from the trust account related to stock redemptions. And on the financing side, they used over $7 million for the redemption of common stock. This confirms that many shareholders cashed out during this period. Let's compare that to the 3 months ended the 31st of March. 2024 operating activities used over $277,000 in cash. Investing activities generated over $17 million, again largely due to redemptions, and financing activities used over $17 million for redemptions. It's clear that redemptions have been a major factor in their cash movements. Digging into the notes, we learn more about their operational status. Papaya Growth Opportunity Corp. Is a blank check company looking to combine with another business. They had their initial public offering, or IPO, back in January 2022. They have extended their deadline to complete a business combination multiple times, most recently allowing them to aim for the 19th of December 2026. This shows they are actively searching for a suitable target, but it also highlights the precarious nature of their timeline. The company is also dealing with a new 1% US federal excise tax on certain stock repurchases, which could impact their cash available. They had not paid all of these obligations by the 31st of March 2025 and continued to accrue interest and penalties. This tax is a growing concern. Remember that class, a common stock subject to redemption. The notes explain that these shares are treated as temporary equity because they have redemption rights outside the company's control. This means their value is adjusted to the redemption value at the end of each reporting period. The huge drop we saw in the balance sheet is a direct result of shareholders exercising these redemption rights. They have several related party transactions going on. The sponsor, Papaya Growth Opportunity I Sponsor LLC, has provided loans for working capital. As of the 31st of March 2025, they had borrowed $2.8 million under one note with the sponsor and $1.2 million under another. This shows a reliance on the sponsor to keep operations going. They also pay their sponsor a monthly fee for office and administrative support. For the first quarter of 2025, this amounted to over $43,000. They also engage consulting firms like Birkeland Associates and LGF CFO Sirs, indicating ongoing operational expenses even without a core business. Now, for some big news that happened after the 31st of March 2025. On the 21st of April 2025, Papaya Growth Opportunity Corp. I announced a business combination agreement with Forbes and Manhattan Resources Inc., or FNM. This is a significant step, potentially turning Papaya from a SPAC into part of a Canadian resources company. And in a very significant move, both underwriters Cantor Fitzgerald and Cohen and Company Capital Markets agreed to waive their entitlement to that massive $15 million deferred underwriting commission. This is likely to help clear the path for the business combination, but it's a big concession from them. Looking at the management's discussion, they admit freely that they have not generated any operating revenue and expect this situation to continue until after their business combination. Their primary focus remains identifying and evaluating target businesses. The substantial increase in net loss for the first quarter of 2025 compared to 2024 is attributed to increased general and administrative expenses. Their liquidity section is quite telling. They acknowledge having insufficient working capital and needing to borrow more from their sponsor. They are facing substantial doubt about their ability to continue as a going concern, which is a serious red flag. This is directly tied to the potential liquidation if a business combination isn't completed by their deadline. And they've identified a material weakness in their internal controls related to the misclassification of income tax payments. While they are taking steps to fix it, it's another point of concern in their financial reporting. Oh, and there is a mention that they were not in compliance with NASDAQ listing rules because they didn't file their Q report on time for the period ended the 31st of March 2024. While they eventually fix that, it adds to the picture of operational challenges. Finally, looking at the exhibits, we see the business combination agreement with Forbes and Manhattan Resources Inc. and an amendment. This confirms the previously announced business combination is indeed moving forward, although it's been amended. So, what is the story here? Papaya Growth Opportunity Corp. I as a SPAC navigating a critical phase. They've seen a massive outflow of cash in the first quarter of 2025 due to shareholder redemptions, indicating a lack of confidence in their ability to find a suitable business combination anytime soon. Their financials show the typical SPAC struggle of high operating costs and no revenue. Compounded by the need for ongoing sponsor loans and dealing with tax liabilities, the business combination with Forbes and Manhattan Resources Inc. is their lifeline, and the waiver of deferred underwriting fees by the IPO underwriters is a crucial step towards making that happen. However, with a going concern issue and a material weakness in internal controls, the path ahead is still very uncertain. My take on this is that while the business combination with FNM offers a potential way out, the significant shareholder redemptions and the company's precarious financial state highlight the immense risk involved in SPACs. The company's direction is entirely dependent on the successful completion of this business combination, and its strength will be determined by the market's reception of the combined entity. A major opportunity lies in the potential synergy with FIM if their industries align well. However, a notable risk is the continued dilution and the pressure from remaining shareholders if the combination falters. Ultimately, Papaya Growth Opportunity Corp. is in a race against time, and the success of this business combination will be the deciding factor in its future. Alright, that's our deep dive into Papaya Growth Opportunity Corp. I's latest filing. What do you think about these numbers and the potential business combination? Let me know your thoughts in the comments below. If you found this analysis valuable, please give this video a thumbs up. It really helps us out, and subscribe for more. And as always, join the conversation and connect with like-minded analysts on our Discord server, linked in the description. Thanks for watching, and I'll see you in the next video.